Hi, Doug Andrew again. In this IUL Insiders episode, we are going to help you understand how to answer questions from your prospective clients, such as, can IUL be used for financial goals other than retirement? See, we make the assumption that most people are coming to us because they want to accumulate their money on a tax-favored basis for tax-free income. And yeah, as far as I'm concerned, it knocks the socks off of most other alternatives where people try to sock away money for retirement. But the answer is absolutely yes. See, it's so flexible. That's why I use it for all kinds of financial goals. I've mentioned some so far in this series, but this is where I want to direct you right now to learn how to help people gain insights into how you can use max-funded IUL for a lot of other goals. I used to assume that people could figure this out. And then when I would teach in an audience and someone would raise their hand and say, golly, could I use this to save for my children's college? I go, absolutely. And other people say, really? I mean, they were so focused because I was talking about retirement, they thought that's what it was for, just for retirement. I'm going, no, this knocks the socks off of a 529 plan. This is tax-free, it blossoms. 529 plans don't blossom when you die and transfer tax-free. So my kids will go to college whether I live or die or whatever. 529 plans don't have a self-completing feature if you happen to pass away. So why would I ever put money into a tax advantage 529 plan and then be obligated to have to use it for college? See, in a max funded IUL, I can use it for tax-free college funding, but I don't have to. Maybe my child goes, you know what, I got a scholarship, Dad, but can I own that policy and use it for the purchase of my first home? Sure, you can't do that with a 529 plan. If Dad dies, it blossoms, and all of a sudden the college funding is totally completed with the death benefit. 529 plans don't do that. So there's a lot of advantages that a lot of people don't think about unless you educate them. So this is why I wrote the left brain side of the book is for the analytical people, but the right brain side of the book is for those people who need to learn by stories and examples. So when we go into this right brain side, by flipping it over, I'm actually going to turn to the table of contents here. And just by reading the table of contents, you will understand different applications or uses for max-funded IUL. Why it is the dream solution for many financial goals. And so on the right brain side, the very first chapter, I talk about one of my favorite subjects, and that's how to be balanced in life. How to have clarity, balance, focus, and confidence. And life is more than just about money. It's about your heritage, your wisdom, your knowledge, your experiences. And I talk about the difference between the swing and the clubs, because indexing is a strategy. See, indexing is like a swing if you were a golfer. When I ask people, if you were going to be playing in a golf tournament, let's say, and you had the choice of using a professional golfer like Phil Mickelson's swing, or you could use his clubs, what would you choose? I'd rather have the swing, not the clubs. And so, see, indexing is a strategy. It's not a commodity product. Indexing is a strategy on how to participate when the market goes up and not lose when the market goes down. It's a swing strategy. The success of max-funded IUL is in the swing more than in the clubs. Yes, I want to choose the right company. I want to choose the right product. But the most important thing is making sure it is designed correctly. It's the swing of how you implement that makes all the difference in the world. I'm going to talk about that in another episode. And so when we look at the swing as far as the max-funded insurance contract can be in life, you're wanting to capture really the swing more than the clubs. So in the very first chapter on this side, I'm talking about how to capture your experiences, your wisdom, your knowledge, your genealogy, your ancestry, and all the good and bad experiences, And it's more important that you capture those and leave behind knowledge, attitude, skills, and habits. That's another acronym. If you can't tell, I like acronyms. KASH is knowledge, attitude, skills, and habits. I'd rather leave behind how to fish to my kids and grandkids than dumping a bunch of fish in their lap. I want to leave behind the swing, not a bunch of golf clubs. See, I've noticed that most financial advisors seem to focus on the commodity or the clubs. Buy this mutual fund, buy this stock, gold or silver. It's not in the commodity. It's in the strategy. It's in the swing. It's the indexing on IUL that makes all the difference. Likewise, I'm talking about in the first chapter on the right brain side, I want to leave behind the swing, how to fish, instead of just dumping a bunch of golf clubs in their lap, because there's a lot of estate planning attorneys that seem to focus on dividing up the golf clubs and the trophies among the kids and the grandkids when you die. Oh, it's more important that you leave behind the swing, right? And so once they understand that life is more than just about money, that it's about leaving behind the wisdom, the knowledge, the good and bad experiences, and how we capture those. That's what engages people to our firm, because I have a whole legacy day of planning. I have a book called Entitlement Abolition, where I help them abolish entitlement mindset with the kids and grandkids and so forth. And so I'm interested more than just in their money, and they appreciate that. Now, the rest of the right brain side talks about different applications of the laser fund that they learned about the details on the left brain side. So listen to the chapter headings. Number 2 is the laser fund for death benefit. So I can use the laser fund just for death benefit. I may want to minimum fund instead of maximum fund. So what am I talking about? Okay. I had a serious talk with my children several years ago, and I broke the news to them. I said, kids, I want to tell you that your dad is not immortal. I'm going to die someday. Dad, what, you're this morbid. I said, no. The fact of the matter is I will die someday. Now, I said, I want you all to celebrate when I die. I want you to all be automatic millionaires when I die. But I'm not going to pay for it. You're going to pay for it. I have some insurance capacity. See, you qualify for insurance based upon a factor of your income or your net worth. And sometimes I have insurance capacity because my net worth goes up that I'm not using. Now, some people say, well, why would I buy insurance if I don't need it? Look at what it does, not what it is. And so let's just say I had $1 million of capacity that I don't need. I would recommend you children buy $1 million policy on me. Now, I may have to apply for it and make my wife beneficiary to get it through underwriting, and then I can change it to my kids, whatever. But if I take out an insurance policy for $1 million, and they can maximum fund it if they want. But if they minimum funded it, they're grandfathering themselves to throw in a huge lump sum somewhere down the road because they're the owner. They're the beneficiary. So you change the owner and the beneficiary over to your children. Now, minimum funding, when I had this conversation, for like $600 a month, they could get $1 million policy on dad. Do the math. You show me any investment, any IRA or 401k, that you put $600 a month into it, and it's worth $1 million. When would it grow to be $1 million net after tax? It would take 30, 35, 40 years. They'd have to earn 11, 12, 13% rate of return in order to have 35, 40 years down the road, a net of $1 million after tax on that IRA or 401k account. They put $600 a month into $1 million policy on their dad. And if I die anytime in the next 35 years, tomorrow, a year from now, 35 years from now, they get $1 million tax-free instantly. They know they can take that $1 million, put it into an indexed universal life on themselves and earn 7 to 10%. $1 million can generate $100,000 a year of tax-free cash flow. That would be the best retirement plan ever. It knocks the socks off of them putting $600 a month into their own 401k. In fact, I often say, if any of my kids ever owned an IRA or 401k, what are you thinking? Because they know better. So, see, that is for death benefit. You can minimum fund, you can maximum fund. If they own a policy on me and later on they have a whole bunch of money, they can maximum fund it or they can minimum fund it. But when you analyze what it does, my heavens, it's like when I used to show my audiences a picture of baking soda on the screen. And I would say, so give me some uses for baking soda. And usually the women in the audience were the smartest, and they would say, oh, it takes the odor out of your refrigerator. You can soak in a soda bath. And one lady said it takes the pop out of a pot of beans. And then eventually somebody goes, oh, it's good for baking. Obvious. Life insurance is good for life, living benefits. But people have been conditioned to think of it as only death benefit. So all the rest are living benefits. Chapter 3, the laser fund for retirement planning, which by now should be a no-brainer, how to accumulate your money and then have tax-free income that will last till they're 120 or so. Chapter 4, the laser fund for working capital. I've talked about this, where some of my clients, they use their laser fund for their slush fund for their business. So that if they see a business opportunity, it's like the infinite banking concept on steroids. They borrow $1 million out of their insurance policy, they buy equipment, they invest in real estate or whatever, they fix it up, they sell it, and they have this money, they put it back into the laser fund. And then they borrow it out again. It's their working capital account where they continue to earn tax-free compound interest on their money while they're using that money in their business because they're using index loans. How about this one? This is chapter 5, the laser fund for school, family, and life. So again, this knocks the socks off of a 529 plan. My heavens, the only thing you do in a 529 plan is put aside money on a tax-favored basis for your kid's college. Well, a laser fund does that and a whole bunch more, and you don't have to use it for college if your child gets a scholarship or something. And so you can use it for that, but just life, just emergencies or whatever. How about number 6, the laser fund for lump sums? There are a lot of people that have lump sums. They get in an automobile accident and they get a settlement for $500,000, $1 million, $5 million, and they wonder what to do with it. I've had many, many widows who their husband passes away and they get $1 million or $2 million. And unfortunately, a lot of widows 5 years later have nothing to show for the $5 million. I could give you horror stories from studies where they've taken 1,000 widows that got $1 million or more, and in less than 5 years, there's only a handful that have anything left to show for it. And the sad thing is, a lot of times people come out of the woodwork, hey, have I got a deal for you? Or the kids, or their nieces, or nephews. Hey, will you help me in my business or whatever? And of course, you want to help your kids. You think it sounds good for a rate of return. And most people who lose money, it's usually bailing out their married kids or loaning them money. It's unfortunate because when you do that without a system to have them repay, which I teach about in chapter 1, you not only lose your money, but then you lose your child because they're too embarrassed to come around anymore, and that's pretty sad. So this allows you to be able to use this for lump sums, that when a widow comes to me, most of their friends have been telling them, oh, pay off your house and do all this kind of stuff. I go, whoa, 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 whoa. If you pay off that house and you need to qualify and get credit as a single person now because your husband's gone, you're going to have a real hard time now going out and borrowing because you don't have any income. Well, yeah, but I got $1 million. No, that doesn't make any difference, see? I mean, they may say, well, that's nice, but just use your money. If you keep the mortgage intact, I've already taught you, the money inside of an insurance policy, I tell a widow, put it right back into a new laser fund on you. And then the interest you're earning is more than the net cost of the mortgage. You'll make more money by not paying off the mortgage. You'll actually sleep at night better when you understand this. But they thank me because then they go down the road and they go, you know what, Doug? For 4 or 5 years now, I've continued to make the mortgage payment, so I've established my own credit. They didn't have to go apply for a loan to do that. They already had the loan. They just kept making timely payments, so they established credit with something they had when their husband was alive. And they're able to make rates of return and so forth. And so when anybody has a lump sum from anything, you can put it into the insurance contract. If you're trying to comply with TAMRA, because that's the only money that's going in, you have to spread it out over 5 years as you've been learning. How about this? Chapter 7 is the laser fund for business planning. So you can use that in business and cover partners, buy-sell agreements, for accumulating money, for acquisition of another business. There's all kinds of ways that I've had clients use indexed universal life for business while they're operating their business to cover themselves with the insurance that's sort of coming along for the ride that helps them do a buy-sell. If you don't know what a buy-sell is, if I have a partner in business and if I die and it's worth $2 million, the partner needs to buy me out. Otherwise, then his new partner is my widow. And maybe she doesn't care. And so what that does is it allows $1 million of life insurance to be paid to that person, and they pay that to my widow, and now they've bought out my business, and it's under a contract. They will buy the business, and my wife will sell the business for a predetermined amount of $1 million. Well, if you're going to do that, you want to do that with tax-free money that blossomed when a death occurred. That's called a buy-sell agreement. So you can use this for business planning. You get through into chapter 8, and it talks about examples of life's emergencies. So the neat thing about this side of the book is we give 3, 4, or 5 real positive stories of how this has been used for life's emergencies, getting laid off, losing not only your job, but maybe you got disabled, whatever. And so we tell stories, but in every single one of these chapters, I give one not so good story, an example of when a laser fund didn't work. See, I want to be transparent. I want them to realize, no, it doesn't work all the time, and why. Every single story, when it didn't work, it's extremely obvious. It wasn't structured correctly, maybe by an advisor, or it wasn't funded correctly. You can't make the bucket big enough to hold $500,000 and put in $30,000 and stop and think it's going to be a great investment. You haven't even leased out the first floor of that 5-story building. So the only time people don't see it perform is when they don't structure it correctly and they don't fund it. You have to make adjustments. You have to carve it down. That's why annual reviews are critical. You can get rid of room, but it's real hard to add room. You have to qualify for a new policy. But if you don't come in and keep it going, it's like if I were to take off from an international airport. Right now I'm closest to Salt Lake International Airport. And if I went around the globe, 26,000 miles, and I was 1 degree off course, 1 degree, by the time I came around planet Earth, I would be over 500 miles away from Salt Lake. I'd be down by Las Vegas somewhere. Because if you're 1 degree off and you don't correct it, you get way off as you continue to veer off. That's why annual reviews are so important. You want to come in and get right back on course. And if you don't have the money anymore because you loaned it to your kids or whatever, you need to adjust and squeeze the bucket size down. Only about 5% of my clients did we ever have to reduce the death benefit, squeeze the bucket size down from 500,000 maybe down to 300,000. The majority of the time, over 95% of the time, people would fill up their bucket and they had more money. That's a nice problem. So they would get another one, and then another one, and another one. Most of my clients that started out with 1 bucket, by the 10th year had 4 or 5 buckets because they had new money. So that's what we're talking about here to be able to have money on hand. Number 9 is estate planning. Again, if you're trying to maximize what you leave behind in a family bank, you will learn that what I do in my family is we have insurance on me, my spouse. We're the oldest, the patriarch and the matriarch of the family. And let's say we have $5 million of insurance in our family bank. Now, whenever one of us passes away, we require that if it was a $5 million life insurance death benefit, that 20% of that, in that case, that'd be $1 million, be allocated and put back into a new insurance contract. I don't even care if it's a mech, and I insure the next oldest, healthiest family member with $1 million in one fell swoop, and that's dedicated for death benefit. And so that then with estate planning, every time somebody passes away in our family bank is what I call it. You'll learn about that in chapter 1 of this side of the book. The family bank gets a tremendous infusion of tax-free capital, $5 million, but 20% of it funds the next $5 million, and then the next $5 million, and our family bank just goes. We grow our family bank faster and bigger than our posterity grows. Now, if that's sunk in, that is one of the best estate planning techniques you could ever have, and it's tax-free. So that's what estate planning is all about. When you go down into number 10, real estate. Now, there's another video episode that I have about real estate, but again, many real estate investors will keep their liquid capital inside of a laser fund because it passes the liquidity test, safety test, rate of return test, and real estate, even home equity, does not do that. You're going to learn you can pay off a house about 2.5 years faster than any method of sending extra principal payments to the mortgage company by putting that money into a side fund where it's earning compound interest tax-free, which is greater than the simple interest after tax declining balance of the mortgage. You'll actually accumulate more money quicker to pay off your house by using a side fund than giving the extra principal payments to the mortgage. But if people are having money to tie up real estate, to pay earnest money, so forth, it's unbelievable how this helps you with real estate management with a vehicle that is liquid safe and earns predictable rates of return. And anytime you pull out money, you keep earning interest on that money while you're using it for your real estate. So it's awesome when you read the examples in here on real estate. Now, number 11 is strategic rollouts. That is so powerful. I have another episode totally on strategic rollouts. I've alluded to them. This is where people who want to get their money out of IRAs and 401ks and the like, get it rolled out, not rolled over, get the taxes over and done with, and reposition the net after-tax monies over a 5-year period, ideally under TAMRA, into a max-funded IUL. And then they're converting to tax-free, and later, when they ultimately die, it blossoms and transfers tax-free, reimbursing them many-fold for the taxes they paid. But every time we do an analysis of a strategic rollout, which you'll see in that episode, you'll be blown away with how sometimes we double, triple, and quadruple people's net spendable income by getting their money out of IRAs and 401ks and over into a portfolio of IUL policies. Okay? The last chapter is the laser fund for tax reduction. Sometimes people just simply want to reduce their taxes. And so there's some stories in there that are unbelievable. We had one couple in California that was in the highest tax bracket. And in 5 years, we took them from the highest tax bracket in California, has the highest state tax plus federal. They were paying like 55% in taxes on their income. We took them from the highest tax bracket to, guess what, in 5 years? A 0% tax bracket. They loved this so much. They were so savvy. They ended up with several buckets, and they have $8 million generating $800,000 a year average in tax-free growth. They don't even need that. They only take out $300,000 a year, and the rest, the other $500,000, is continuing to compound. Now, that's what I mean by tax reduction. If you could take people's tax liabilities down from this down to this, or this to this, learn the stories of how we have taken many people from $200,000 of taxable income down to $80,000. They still have $200,000 of income, but $120,000 doesn't show up on their 1040 tax return. We save them tax on $120,000 every single year for 20 or 30 years. But that couple went from the highest tax bracket to a 0% tax bracket in 5 years using the laser fund. Actually, 4 laser funds is how many we did. So these are called strategic rollouts, tax reduction plans. There's usually 4 or 5 stories for every one of those of how it works. And there's 1 story in every single one of those chapters of when it didn't work, why it didn't work, and it's very obvious because the advisor wasn't proficient or the client didn't finish funding it the way they said, or they didn't come in and adjust and keep it on track to earn the best net internal rate of return. So many people will learn more from stories. They think more right brain. It's matters of the heart. That's why we teach high concepts with high touch. Right brain, okay, right brain, left brain. Because when you have, let's say, a couple and one makes decisions more logically, the numbers, but the other one makes decisions more by the way they feel, matters of the heart, by the stories and metaphors, then you have them both on board. Don't assume everybody thinks like you do or makes decisions using logic or the way they feel, or else you will miss out on half of the relationships with your kids, your grandkids, but most importantly, with these clients. I teach this to doctors, and they miss out on half of the relationships with their patients when they don't understand how to relate to both this kind of a person and this kind of a person, and usually there's 2 in a marriage relationship. So use the right brain, left brain, teach, tell stories like these, use metaphors, and watch your business go through the roof.